welcome to the January CGBN Commercial Global Business Network webinar. We hope you're all having a fantastic day and a good start to the new year. Before we begin, many of the persons listening and or watching this webinar may be direct competitors in the real estate brokerage business. Therefore, to avoid any liability under the federal or state antitrust laws, any discussion or of competitive business practices and or the amounts of fees and or commissions charged or to be charged by the real estate brokerage companies to their customers or clients and or compensation and or splits paid or to be paid by brokerage companies to other brokerage companies is strictly prohibited. It is NYCAR's policy that it will not entertain any discussion that creates the potential of a violation of federal or state antitrust laws at any meeting, podcast, or conference sanctioned or sponsored by NYCAR. Please note that this session is being recorded. To ensure a smooth experience, we kindly ask anyone who is not presenting or part of the panel to please mute themselves and turn off their video recording. Our session today will run about 1.5 hours. We'll start with a presentation from Mark, followed by a Q&A segment for Mark. And once that's concluded, our newly installed chair-elect, Getty Greer, give a little wave there, Getty. He will go ahead and host that needs and wants segment, which will last about a half an hour. After that session is over and this recording has concluded, you'll be able to find it on the CGBN YouTube channel to watch again. And please, in the meantime, take special moment to share your information in the chat, including your name, email, phone number, and any wants and needs you may have. And for those of you who may not know me, this is my second time doing this, so forgive all the stops and sputters and starts and what have you. My name is Marcia Collins-Moroz. I'm the current chair of CGBN. And as I mentioned, Getty Greer is the vice chair. And joining us today is NYCAR's president and immediate past chair, Dimitri Lockman, along with our past CGBN chairs, Ahmed Badat, Teresa Mueller, and Bill Caton. So today's webinar, let's get to this. Impacts of tariffs and trade on international investments in U.S., unlocking cash flow hiding inside your buildings. Cost segregation is one of the most powerful yet underutilized tax strategies available to property owners. By reclassifying components of your property, including things such as lighting, flooring, and exterior improvements, you can accelerate depreciation and pay less tax sooner without changing how you operate your property. Our engineering-based studies, that is CSSI's engineering-based studies, typically help owners realize $30,000 to $80,000 in tax savings for every $1 million in building value within the first 5 years. In this webinar, you'll learn how to reduce income tax liability legally and strategically, free up immediate cash flow to reinvest or expand, maximize savings with bonus depreciation, understand the latest changes from the One Big Beautiful Bill and what that means for all property owners. And if you happen to be someone who develops or advises on real estate, this session will very much put dollars in your pocket as well. So let's not waste any more time. I want to introduce you to Mark Gross. He is the National Account Executive for CSSI Services. Their company is a premier cost segregation firm, having completed tens of thousands of studies over the past 20 years. Mark has provided cost segregation services for property owners nationwide since 2010. His projects include multifamily apartments, single tenant, triple net, industrial, retail, hotels, office, etc. If it's commercial, it has a potential of cost savings through this program. His previous background is in upper management, overseeing supply chain and operations for large manufacturers and a retail chain. Mark, thank you for being here with us. Please go ahead and share your presentation.
Sure. Thank you very much, Marcia. I appreciate it. Yeah, let's go to the first page of the slide. What I'm going to be talking about today is primarily the cost segregation studies that we provide. But just as a point of reference, in addition to the cost segregation, we also do research and development, 179D energy tax studies and things of that nature. But again, today we'll be focusing on the one big beautiful bill and cost segregation, and how this can be a great way to help yourself if you own commercial property, or help your clients. It's a really good value add for that purpose. Let's go on to the next slide. One thing we're going to be focusing on here again is the one big beautiful bill and 100% bonus depreciation. As a point of reflection here, let's back up to the Tax Cuts and Jobs Act at the end of 2017. What that did was it made 100% bonus depreciation for that year, but it had a sunset clause. Now, what is 100% bonus depreciation? That means that any property that you have, or components of that property which have a less than 20-year life, can be depreciated 100% in the first year. So normally what a CPA will do is take a look at the acquisition cost, subtract the land, and then depreciate it straight line method over 27 and a half years for residential properties, or 39 years for commercial properties. We do the alternative method based on the IRS guidelines, which is to front end load those costs. Now, with the Tax Cuts and Jobs Act at the end of 2017, like I said, it had 100% bonus, but that has a sunset clause. So it was 100% in 2022, up through 2022. Then it went to 80% in 2023, 60% in 2024, and then 40% in 2025. Now, what happened with the one big beautiful bill that was signed on July 4th of 2025, and it made 100% bonus depreciation retroactive to January the 20th. So that was based on any properties that were acquired or placed in service after January the 19th. I'll give you an example. One client here in Michigan where I did a study for him, and he acquired it, went into service on January the 17th. He was kind of bummed out by the fact that he only got 40% bonus depreciation, but he still went ahead and did the study anyway because return on investment was still advantageous in spite of that decrease. So let's go on to the next page. And what we have here is talking about what is cost segregation. And the one thing that I referenced is the fact that our studies will identify all the parts and pieces that have a less than 20-year life. So for instance, let's say that you have components which are 5-year properties, such as carpeting, and you might have parking lot, which is 15-year property. Again, with the bonus depreciation, you can take that and depreciate it the first year. I saw a note that came up talking about recapture, and I will be talking about that. But just to address it now, there is something called a recapture tax, and what we do is one of our pre-qualifying questions is we'll ask the client, what's your hold period going to be? Are you planning on holding the property for at least 3 to 5 years? Because we want to make sure that the return on investment that the clients get from the tax benefit from the cost segregation will far and outweigh whatever the recapture tax is. And our experience is that anybody who will hold on to the property for at least 3 to 5 years will have a return on investment which will be greater than that. But that's a great question, and the reason why so many of our clients do it is because it just makes financial sense. If you're planning on buying a property and flipping it within a year or two, we recommend you don't do it. Very rare exceptions. I've had a client with a very large property. They're planning on doing something in 2 years. And I talked about the recapture tax, and they said, you know what, we're very sophisticated, and I understood the ramifications of it. And in spite of that, they knew that the ROI they were going to get on the tax savings was going to far outweigh what it was going to be with a quick flip. But typically, we do not recommend that. So how's this process works? Let's say somebody has $250,000 in income you got to pay taxes on based on what your tax rate is. Well, what if our study creates an additional $250,000 depreciation That's a non-cash expense. So you look at, your P&L statement, you'll see that you'll bring your income down to zero, and therefore you would have no tax liability. Now, one of the other things people will ask is, well, what if the depreciation or tax benefits is going to be far and exceed what I need in the current tax year? Well, any excess can be carried forward indefinitely until it gets used up. And one thing I would recommend is that people talk with their tax counsel as far as what their unique circumstances are. Because whether or not you're a general partner, maybe you're a limited partner, or if you have what's considered to be the gold standard as a real estate professional, you can not only take that tax benefit against the property income, but also against your spouse's W-2 income. So, for instance, I have one client I'm working with on the East Coast who's a neurosurgeon with a high W-2 income. And in the course of conversation about doing studies for him, he said, oh, by the way, my wife is a real estate professional. So he understood that the tax benefits that we provide for his properties can not only go against the income from the properties, but also against his W-2 income. But again, what we suggest is that you talk with your tax counsel regarding what your unique circumstances are. It's really not possible for me to give you an exact way in which this would benefit you specifically. That's why we recommend that you do that. Also, one thing we reference here is the engineering method. One thing that we will do with every single study is a physical site visit. We know that being able to do a site visit physically will not only be able to provide the maximum amount of depreciation and tax benefits, but also better be able to defend that study in the event of an IRS audit. I'll give you an example. A couple years ago, I did a large multifamily property in Chicago. And several years later, they contacted me and they said, oh, we're being audited by the IRS, not because of the cost segregation study, but they're in there, and while they're in there, they're digging around, they're asking questions about the study. So they gave me a laundry list of questions in that regard. I sent that list on the corporate. I got a response in less than 24 hours. I sent it to the client and never heard back. And that's what happens every time. None of our studies have ever triggered an IRS audit, and we've been able to successfully defend every one. And the reason why is because we don't make this stuff up. It's all part of the IRS tax code. So that's kind of how that works. We can go on to the next page. And what's interesting about this one is the cost segregation budget analysis. When you look in the upper left-hand corner in that one bucket on the far left, you'll see a 39 and a 27.5. Again, what that references is the fact that most property types are going to have a 39-year straight line depreciation. Residential properties will be 27.5 year. So some people think the misnomer as far as, well, if I get 100% bonus depreciation, I'm going to get 100% on the entire building. Well, that's not the case. It's based on whatever has a less than 20-year life, you can depreciate that 100%. There's still going to be structural components of the property that still need to be depreciated straight line method. What's interesting is a point of distinction about a short-term rental, and I see a lot of mistakes that CPAs will make on depreciation schedules. They'll think that a short-term rental is classified as residential or 27.5 years, when in fact it should be 39, just like a hotel is. So and that type of thing can be fixed with the next tax filing. There's something called a Form 3115, which can correct that. And the other misnomer that some people have is that you can only do a cost segregation study in the year of acquisition, and that's not the case. You can do it reasonably, probably within the last 5 to 10 years, depending upon the size of the property. Because each year you wait, portions of the property will be straight line depreciated, so there'll be less to be able to depreciate with that. What's interesting about the 3115 form is that you do not need to amend previous year's tax filing. So let's say you acquired a property in 2022, you got your, you didn't do it then, but you did it for 2025, what would happen is that you would be able to still get 100% bonus depreciation because it's based on the year of acquisition. It's not based on the year in which you do the study, which is another misnomer. Sometimes people think it's based on that. From a timing perspective, when does it make sense to do a cost segregation study? Well, that really has to do with when you're planning on filing your taxes. This is the time of year right now. We're incredibly busy because people have acquired a lot of properties in 2025, and they want to be able to do a timely tax return for their business March 15th and personal April 15th. So we're getting those studies completed now. However, let's say that you were planning on doing a tax extension into the fall of 2026 for your 2025 taxes. You can actually wait and get that done later. There's some people, especially I work with a lot of multifamily syndicators, where they definitely don't want to do that because they want to make sure that they get the K-1s out there for their clients who are limited partners in that situation. Again, looking back at this slide, you can see some of the examples. I'm not going to read through all of them, but you can see examples of some things which would be considered to be your personal property and real property and land improvements. And some of the examples I like to talk about is we know that land can't be depreciated, but one property type that would make sense to do a cost segregation study on is a golf course. When you think about it, a golf course is primarily land, right? Well, what you're going to have in a situation like that, you're going to have a clubhouse, you're going to have a parking lot, you're going to have landscaping, things of that nature. So despite the fact you can't depreciate the land, there's still going to be a lot of components within that property that makes sense. Another interesting one that I work on sometimes is clients that acquire a property. Let's say it's a triple net lease, it's on a land lease. And I'll give you an example of one I did in Florida. It was a Walgreens. They acquired the property, but it was on a land lease, which meant that they didn't own any of the land. So in a situation like that, what a CPA would typically do is take a look at the purchase price, subtract the land value, and then depreciate based on that. But if you have a land lease, 100% of the purchase can go towards the building cost and what you can depreciate. Another situation is that you might have someone who I ran into this actually this week again, where someone has a duplex and they live in one as their primary residence and they rent out the other one. Well, in a situation like that, you can do a cost segregation, but you can only do it on the unit that you're renting out. You cannot do a cost segregation on your primary residence. And we'll get into this later. It talks about what are the questions that we ask in order to do a cost segregation study. So let's go on to the next page here. And what I like about this one is this is the graph which shows what's the difference between straight line depreciation, regular cost segregation, and then also bonus depreciation. If you take a look at the blue line there, that is where someone will acquire a property, subtract the land value, and just do a straight line depreciation over your 27 and a half years for residential properties and 39 years for other property types. The red line is without bonus, and that would be someone who would do the 5-year property rather than depreciate it over the number of years. They would do it over 5 years, and for instance, the parking lot would be over 15. But what's huge is with the bonus depreciation, whereby again you can take any property which has a less than 20-year life and depreciate that the first year, and that's a huge advantage there for people. So let's go on to the next one. So how does our process work? So let's say someone buys a property, and what we would do is we have a questionnaire which will ask them questions about the property and about themselves as far as their tax rate. So we'll ask what the address is, what the purchase price is, excluding the land. And I've had some situations here recently, especially in the Bay Area, California, or Manhattan, New York, where the land value is a much higher percentage, and let's say it's in a rural tertiary market. So in some cases that can have a huge impact on the tax savings because again, you can't depreciate the land. Also ask for the business entities, square footage, number of floors, also the renovation budget. There's something called a PAD or partial asset disposition, whereby we can not only do a study on the initial acquisition, but also on the renovation. I have a lot of multifamily syndicators who are buying a property, and what they're doing is maybe converting a Class C to a Class B, and that could occur to renovation either in that existing year that they acquired the property, or sometimes it goes over multiple years as the units turn. In a situation like that, we do a study not just on the initial acquisition, but also on the renovation, the capex that they're doing for their property each year. What we do is at the end of the calendar year, we request an Excel spreadsheet with information about what was completed in that calendar year, and we'll do a supplemental study for that as well. Also, 1031 exchange. That's one of the questions that we ask. We can definitely do a study with a 1031 exchange. There's an extra hoop we have to jump through, and that is to find out information about the property that was sold as a result of the 1031 exchange, such as, when was it acquired, how much was it acquired for, and how much was it sold for. And typically we can still make the ROI work for a 1031 exchange. In some extreme examples, it doesn't make sense. But our objective is to make sure we have all the pertinent information so we can provide a client with a free and estimate, which will really be something they can hang their hat on. When we come up with this analysis, it will give a conservative and a high-end estimate of what the anticipated tax savings are going to be. Virtually all of our studies will fall within that category. I've had some recently we've actually exceeded the high-end estimate, so that's another thing to take into consideration. The owner federal tax rate, obviously, if you're at a 22% or a 37%, that's going to have an impact on how much your tax benefit's going to be, because we take a look at the tax benefit and also look at what your tax rate is and come up with the tax benefit based on that. The other thing I referenced here earlier was what the hold period's going to be. Again, because of the recapture tax, we want to make sure that someone holds on to it for at least 3 to 5 years in most instances, so that the tax benefit that they get is going to far outweigh whatever recapture tax is. And one of the other things that I addressed here earlier was regarding whether or not someone resides at a property, such as that duplex example that I gave. I had another one. It was out in Oakland, California, where they owned a duplex, lived in one, and rented out the other one. In that particular case, what they said was, well, we're planning on moving out of this and buying another property, but keeping this as a rental for both units. And in that particular case, we suggested just go ahead and wait, do a cost segregation when for the entire property once you vacate that as a primary residence. So let's move on to the next one. What type of building types make sense? And you can see here's examples of virtually everything. As far as the percentage, what you're going to have situations like in the manufacturing facility, it might be a distribution, warehouse, manufacturing, things of that nature, whereby you're going to have a less per square foot or per dollar amount, because think about it, most of those properties are going to be like an 80-20, where 20% will be office square footage and the other 80% will be in the other facility. And in the distribution manufacturing area, you typically have a lot less per square footage in those properties that can be depreciated versus what you have in the office area. I'll give you an example of a couple I've done here recently. One was a larger multifamily in Chicago, where in 2025, for just the one property, the tax benefit was $1.8 million. Another recent one was a strip mall, actually a large one up in Milwaukee, and saved them about $900,000 in 2025 taxes for that. The vast majority of the properties we do fall within this category for people who own the property. However, if you look in the lower right, it talks about leasehold improvements. We sometimes have a situation where someone will be a tenant in a property and they don't own it, but the TI or tenant improvements is being paid by the tenant themselves. In a situation like that, we can also do a study for the tenant. But frequently, in those scenarios, you have the landlord, which will pay or maybe partially pay for the leasehold improvements. Another one I've been working on here recently, a number of the Edward Jones financial offices, whereby someone will convert a property and have office for their Edward Jones, and they're being reimbursed by Edward Jones for part of the leasehold improvements, and we have to take all that into consideration as well. So again, how does our process work when someone is interested in moving forward? Once they give us the information from the preliminary analysis, we come back with a free indication of what their estimated tax savings are going to be. And when they decide to move forward, 50% of the fee is due up front. The other 50% is due when the study is completed in approximately 4 weeks. What we'll do is schedule a site visit. We'll have someone go out to the property and take pictures of the entire property. In a situation such as like a multifamily where they've got a number of units, we don't need to go into each individual unit. We need to take a look at what a representative unit. So, for instance, let's say they have 3-bedroom, 1 bath, and a 2-bedroom, 1 bath. And in that particular case, we would just need to go in and take pictures of each representative unit, not every one. That gives us the information that we need. Our engineers can take a look at the one representative unit and extrapolate out what the tax savings are going to be for that. So it's less disruptive for the tenants. And of course, we need to take pictures of all the common areas as well. So that's pretty much how the process works. And go on to the next one. And does anybody else have any other questions?
I only saw one from Getty, unless you saw something else. I saw something from Dr. Mustafa. Let's see, but I think you might have addressed that. He was asking if there was any recap penalty.
I have a question too.
He addressed my question.
Oh, he did? Okay, just making sure. Okay,
yeah.
All right. Yeah. So with regards to additional questions, go ahead, Ahmed.
Yeah, so Mark, for a nonprofit entity, the cost segregation does not work because they are tax exempt. But if they own a property, an office building, where part of the tenants are paying rent, doesn't that change the scenario then?
I would think so. Be honest with you, I haven't run into that particular scenario. I'd want to run up the flagpole. I don't want to give you misinformation. Yeah. But you're right. As far as if someone's not paying federal taxes, then there's no benefit there. So it probably depends on what is there a separate LLC that owns that, or what? I have to have more details to be able to address that.
Yeah, because I remember when you've been doing this for a long time, and at Main Street, when you did this, and I was thinking to myself, because part of the Main Street office building, we have a bunch of tenants there. So I think it would be good to know, how that is structured, because I think that may not be part of the nonprofit, because these are for-profit entities that are renting there. Mm-hmm. Number one. Number two, and as you said, it may be a separate LLC. 1, 2. The other question is, You ever come across situations where you've been asked to do a cost segregation for a buyer prior to, so if we do a cost, financial analysis of a property you have a client who wants to buy it, does that ever feature as part of the, part of the analysis?
Yes, that's a great question. I actually have a number of commercial property brokers who like to have this information up front when they have a property for sale, because what
Right.
they can do is they can provide that information to the potential buyer, which will give them an idea as far as the savings that they could have. So yes, I frequently do that for brokers and for others as well.
That's a great idea. So let me go ahead now and ask Dr. Mustafa to go ahead and unmute so you can ask your question. Go ahead.
The recapture tax I was referring to was from the first statement that you was talking about the 100% depreciation. Is there a holding period on that?
Holding period.
Yeah. I think there's a limit up to $1 million for the 100% depreciation on anything you have. Now, do you have to hold that property for a period of time? Not talking about cost segregation, but the 100% depreciation that referred to time and time again of how much you can depreciate property in the first year.
Well, you can depreciate up to 100% of any of the components within the property which have a less than 20-year life.
Okay, I'm not referring to that. That's all right.
There's no limit on that. But as far as the recapture is concerned, there is a recapture tax, and it kind of, I'm not trying to evade the question, but the specifics really are different depending upon what their tax rate is, the capital gains, and things of that nature. So we'd have to have a little more details to see what it makes sense or not. But as a general rule of thumb, if someone holds onto a property for at least 3 to 5 years, return on investment they're going to get on the tax benefits are going to far and outweigh whatever the recapture taxes are.
Mark, I wasn't talking about cost segregation. You enter that with talking about I forgot the name of it, 100% bonus. So entirely different thing. I'm moving on. Thank you very much, but that wasn't what I'm referring to. Not cost segregation, but you mentioned that you can 100% bonus depreciation on business that you have and whatever you acquire in your business. The cost segregation referring to is basically property that you have. So I was talking about bonus.
Yeah, precisely. Yeah, we're not talking about the business aspect as far as, like, for instance, if you acquire a vehicle or something like that. We don't get into that at all. What I'm talking about strictly is the property.
Okay, now one last question. Now, you mentioned the accounting that you do. Is the client, are they allowed to determine what type of method of accounting that they would use, such as double declining balances or some of the digit or anything like that?
Yes. However, when you do this, it's a write-off in the first year, so it doesn't pertain to the double declining balance. I mean, they might be doing that in previous years, but when you do the cost seg, it's going to go ahead and depreciate it. That's why, let's say someone has acquired a property in previous years, we take a look at the depreciation schedule to see what the balance is, and that's what we can do a depreciation on what the balance is.
Mark, I have a little bit of a fuzzy concept of what happens further on down the amortization line. I understand that you're getting 100% back for 20% for properties that have 20 years of life left, but what happens to the rest of the amortization line? They get their refund back. And now what happens as they go along through their time in their property?
Okay, first I'll point a distinction. It's not actually a refund, it's a deduction that you get. So there was something back in the CARES Act where there were refunds, but that's no longer applicable. So what happens is when you do a cost segregation study, the tax benefit would be for that particular year for the components with a less than 20-year life. The rest of your structural components are still going to be depreciated over either 27 and a half years for residential property or 39 years for other property types. So there's still going to be a good portion of the property that will have straight line depreciation, even if you do a cost seg. It's not 100% of the entire building. It's just on the components which have a less than 20-year life.
But I still don't quite understand.
Actually, Brian, it declines.
I still don't quite understand.
Excuse me, point of order. Could you just one at a time? And if you'd like to be recognized again, Dr. Mustafa, let's wait till Brian, are you finished with your question, or did you want to amend that question or append it? Please.
I'm still, how does the refund, is I think how you're putting it, impact the amount of the depreciation as time goes on? If you're taking all of this lump sum up front, how does it impact the rest of does it go just by 39 years?
Yeah, let's say, for instance, someone buys a property for 1.2 million and land is 200,000. So you have $1 million that is depreciated straight line method. Let's say you do a cost segregation, and let's say 400,000 of that is part of the depreciation for the 100% bonus. You're still going to have $600,000 left on that property, which will be straight line depreciated over either 27 and a half years or 39 years, depending upon the property type.
Okay, that got me. Thank you.
You're welcome.
Dr. Mustafa, did you want to follow up on something there?
Actually, we're talking, what Brian was talking about was the lineage. He showed a line. Okay, after you take depreciation in the first year, the amount of appreciation each year declines by the amount of appreciation that you took prior to that. So it's a declining process. So you don't get 100% each year. You get the remaining balance of the amount of depreciation you take in the first year. So if you take 60% in the first year, now you got remaining of 40% for the entire remaining part of it. If you take another 20% in the second year, now you took 60%. So now the next years you have 40% remaining.
No, the depreciation for bonus depreciation is just on the first year. It's not a reoccurring depreciation for cost seg.
That's once again, that's depending on the method that you use, and I'm not going to argue with that. It depends on the method that you use. You don't have to use the 100%. That's why I was asking you about the accountant and who do they choose to do the accounting procedure. When you choose the accounting procedure, that determines the remaining balance of the depreciation. So, for example, some accelerated depreciation have more in the front years than they do and the latter years. So let's say if you plan on doing something in 10 years, you will take a accelerated depreciation method to give you more in the first 10 years than you have in the latter 10 to 30 years or 39 years. So there's other different types of appreciation methods to use to give you more upfront, depending on the strategy, the tax strategy that you have.
Yeah, for most of our clients, and it's my experience is it's very rare for someone to do this, but you can opt by property type not to do bonus on everything. For instance, maybe you want to do it on the 5-year property, but not on the 15, so you have more to depreciate in future years. However, almost 100% of the time, the clients will want to get the maximum amount of depreciation in the first year, because they can have a greater return on investment for that rather than doing portions of it in future years.
Okay, well, I'm suggesting that there's a strategy there that people own their property for more than 5 years. So sometimes they strategize over the 5 year period. And so there's other methods there. Okay, I'm gonna end this here. There's other methods that you can get more depreciation in the 5 to 10 years than doing the 100% bonus.
That's correct. But again, the reason why people do the cost segregation, time value of money. They know that being able to get that up front is going to be a much greater ROI for them rather than doing it in future years. But, there may be some situations where, for whatever reason, someone would want to do what you're suggesting. But that's not what I run into as a norm.
Okay, those were some great comments and questions. I have a couple for you. So being that we're a global committee here from NICAR, let me ask you, do you run into any cases where you're having to do the analysis for properties in other countries? Have you experienced that? Has your company experienced that?
We have. I've had some requests for, like in Paris, France, and some parts of Asia, and quite frankly, the numbers have come back where they haven't been favorable because the tax rules for international properties is different than what it is for U.S. And for instance, you can't take bonus depreciation for international properties. So the examples that I've had to date have not been advantageous. The last one was a few years ago. I actually had this question from Dimitri, and I went ahead and I asked our corporate if there had been any changes to that, and they came back and said, no, it's the same as what it's been before. So I'd be happy to run a free analysis for anyone, but I would suggest that we look at properties that are at least $20 million or greater and then see if the ROI is there, if it makes sense.
Good to know. And then with regards to international clients, that now certainly when they're buying properties here in the U.S., all of this can apply, including the bonus, even though they're not U.S. residents or not identifying as for tax purposes as such.
Well, in a situation like that, if it's a U.S. based property, they would typically have some sort of LLC, which is U.S. based, right, that's owning that property. So in that particular case, it would pertain for those.
So the U.S. LLC. Okay. Then my other question, we talked earlier, when does this make sense to go down this road in expense and time? Is there a certain break-even point, dollar amount? Should we only be suggesting this to our clients if they're looking at properties at $1 million and above, or is there I think we talked about actually a lesser number, which surprised me.
Yeah, it's a pretty low threshold. We suggest at least $350,000 or greater, excluding the land value. It can't depreciate the land. I've actually had some where it's been in the 200,000, 250 range. However, the return on investment on that might be maybe 5-10 times what the cost of the study is. So, but typically it's going to be for clients that are 500,000 or greater, but especially we've had some situations where a portfolio of properties where maybe they have 10 or more. In fact, I'm working on one right now that has a number of smaller properties. In a case like that, because of the volume of them, we can have an attractive ROI on that for a lower cost. But that's why we run the analysis. But rule of thumb, typically 350 or greater, excluding the land value.
So I'm assuming that once you identify that this will be a savings, that you continue to stay in the process for however long, and that there would be regular, can you give me the logistics? So you do the study, you go, yep, there's money to be saved here. Then what's next?
What happens is when we get an engagement for the client, they'll pay 50% of the fee. We will schedule a physical site visit. The study will be completed in approximately 4 weeks. It gets extended a little bit greater as we get closer to the tax season right now. And then what happens is the remaining of the balance is due at that point in time. And typically what happens is I provide the report to the client and their CPA, and we never hear back from them. We
Okay.
have some CPAs who are not as well versed in real estate, and they want us to hold their hand and walk them through the process. There's no additional charge for that. We'd be happy to go through the results and inform them as to how they can apply the results into their tax return.
Oh, great to know. And then this is as bad as when you go and visit a property for a client and they say, so what do you think it's worth? Well, we can't answer that until we start doing some of the research, right? So without holding you to any dollar amount, can you give us an idea, low end, high end? What is a cost segregation analysis? Like, what do they run typically?
For a smaller property, it might be in the $2,000-3,000 range. I mean, this is one I just got here today. It's going to be $3,800, and we're going to save between $43,000 and $56,000. Another one here. This is down in Florida. It's a retail property. The fee is $6,800. We're going to save them about $700 to almost $1 million. So the return on investment is really huge.
It's there. Absolutely. Yeah. That's really great to know. Anybody else have additional questions? You can just unmute at this point. I think we've all been very courteous of each other. You don't have to bother to raise your hand at this point.
No, but thanks, Mark.
Yeah, this has been great, Mark. Really great.
You're welcome. It was my pleasure.
I think then, let's see something here in the sideline here. It says something too. Let's see. I think, nope, I think that's it. So we'd like to thank you very much for this terrific and very timely presentation. And don't be surprised if you hear from several of the attendees here as they reach out to their clients and explain to them what the cost, the benefits can be, the savings, the cost savings. So with that, we're going to go ahead and end the recording. Then Getty's going to go ahead and take us into the wants and needs section.